Welcome back. My name again is CryptoCube, and this is a continuation of the trading with indicator lesson. I never envisaged that this lesson would take so much of my time like this. Seriously, I've been recording for like 1 hour 30 minutes or 2 hours now. I never planned that just talking about indicators can take so much time. So that is why I have to split these videos into like indicator by indicator, which the first one was the moving average, the second one was the RSI, the third one was the MACD and stochastics, and now we are proceeding to the volume indicators. I already talked about volume price analysis in a previous lesson, so I wouldn't be going into details on the traditional volume here, but I will just show you a different type of volume, and I think I will make this very snappy because the indicator I want to talk next about, the levels indicator, wow, it's gonna take a lot of time, so I don't want to consume a lot of time much more, but then let's get right into it. So the volume indicator is a technical study tool that shows us the quantity of contract bought and sold at a particular period. The volume bar we see is also an indicator. As you know, I said in my volume analysis video that volume shows us the amount of buys and sells that occurred within a particular trading period. So it helps us to recognize when the quantity of buy or sell increases or reduces, so we can take notable actions. We also have other volume indicators, some of which are the unbalanced volume OBV and money flow index MFI. Some may argue that the money flow index is not exactly a volume indicator. It's okay, but then it takes its data from both volume and price, so we can also use it as a volume indicator. They work as well as the default volume indicator, but if you find it hard to read the highs and lows on the traditional volume column, the OBV or MFI will just be right to use and read. Unbalanced volume measures buying and selling pressures, and so can be called volume, momentum, or strength indicator. Remember, we have the momentum indicator and the strength indicator, which they are the RSI and the MACD, right? So the OBV works just like them. The unbalanced volume OBV9 is simply a running total of positive and negative volume. Positive denoting buy and negative denoting sell orders. A period's volume is positive when the close is above the prior close, and is negative when the close is below the prior close. What this means is on the unbalanced volume, the line is positive, as in it goes up if the price closes above the previous candle's close, and it comes down when the close of the candle is below the previous candle's close. That is what I meant by that statement. A period's volume is positive when the close is above the prior close, that is the prior candle or previous candle close, and it's negative when the close is below the prior candle close. This means they rise when buy volume and price increases, and drops when sellers are in control and price drops. So it becomes easier to spot divergence in volumes. Here we are with divergence again. Now the MFI is an oscillator like the RSI, but this takes data from both volume and price to calculate when price is either oversold or overbought, while the RSI deals with price alone. Likewise, it can be used to spot divergences like other indicators. So let's quickly go and deploy these volume indicators, and now we can use them. So let me go to the 4-hour first, and then we come to the indicator. This thing at times is confusing. I'm on a 4K monitor, and every time I want to make a video, I have to downscale it to HD, or is it 1080p. That is FHD. I'm on UHD, so at times this it gets smaller, so I can't see exactly some things I see when I'm in full screen mode at the 4K. So here we are looking for OBV. Or should I even deploy the OBV and the MFI together? Let's do one by one. So this is a traditional volume indicator, right? Let me turn that off. Now we have the OBV, which is the unbalanced volume. It is said that when price is rising, we see it rising, and when price is dropping, we see it drops, which is exactly the same thing that is happening here right now. So what do we want to notice here? This has no point like from 0 to 100. It is purely volume. As you can see, we have 125 million, 130 million, 135 million. And the way this is calculated is once you have price rising, it keeps adding to the volume. But once it's reducing, it keeps removing the reduction volume from the total volume. So instead of using the exact volume that was traded in this particular candle, you won't see it. But you see that it's coming down. So how do you want to use this? Is to spot divergence. Divergence is the key here. So let's see if we can get to see a divergence. There were some trades where we spotted divergence on what's it called, on RSI and Co. I think it was here. So we have here making an higher high. Do we have higher high on low? We have higher highs on volume. Volume is showing that this move is correct. There is no anomaly about it. So you are moving on. If you are in a long trade, you keep playing a long trade. You are not looking for shorts until you spot a divergence. Now we have this point to this point. Do we have a divergence? No. Everything is normal. But then there is something here, I think. Okay, it's normal. Nothing. Let me make this a bit so I can see it clearly. Okay, here is like we have a divergence here. Here we have price. If you can see this, we have price making a sort of lower lows from this particular low. Let me use this magnet fish shot. From this low, as you can see, this is a straight line. The price is just below it. So we have a lower low here. And what do we have? On volume. This side will be this side. This particular high will be somewhere around there. Yes. Or even if we use this side to this side, it's making an higher highs. Is that not an anomaly? That's an anomaly, which means there seems to be money coming into the market, but the money coming into the market is not reflecting on price. So we have a divergence. And what happened the very moment you have a divergence? Price kept crashing down. You can wait below this low for it to close below this low for you to go short. So that will be on close of this candle. Or you can, the moment you spot it, you can also go short. You just have to find a way to play around all these things yourself. I am not going into detail on strategies on using volumes and co. I just want to give you a basic idea of how to use volumes. So let's see. I don't know. I have shifted this thing, but I'm trying to look if we can get something like a bullish. It may be harder to spot actually, because it's not exactly, I don't know. So let's keep looking. I think we have one here too. I see this low. Or is it between this low? No, I see this low to this low. I think is this higher. Oh yes, it's higher. So here to here, we have the divergence. And what happened? If you have longed on this candle, your stop will be below here. So this down move wouldn't have taken you out. Then you'll be in profit on this particular move here. So that is basically what you just want to see on the unbalanced volume. You want to see divergence, but this thing is not giving you the accurate. Like you can see, I have to be turning it up and down because it's not limited to a range. It can go as high as it wants, it can also go as low as it wants. So you have to be adjusting and adjusting, which doesn't make sense. All right, let's quickly look again into the MFI, which should do virtually the same thing. So once you money flow index, we have another one which is the checking money flow. You just have to study all these things. They are basically the same. Okay, this now is compressed between 0 and 100. We also have the overbought zone, and we have the oversold zone. So like we said in the RSI and the stochastics, when price is overbought, you want to be looking for sell signals, as it shows an extension that a lot of FOMO and other things is coming into the market. Likewise, when it's overbought, there is a lot of capitulation and panic, or a lot of sellers are a lot of buyers are looking. The selling has been overextended enough, so it's due for a move to the downside or to the upside. So here as well, we want to look for divergence. Divergence is a key with most of these indicators. So I think we have a divergence somewhere here. Okay, here to this point, which is here to this point, and to this point, we have divergence, right? And here to here, we have divergence as well. So the break of all these lows, if you had waited for the break of these lows, that would be at this particular point. So you'll be shorting there, and then you'll be in profit on all these profits. There are times, as you can see, it's way below the mid-range. So waiting for the lows of the divergence to break may not be a good option. So at times when you spot a divergence, you may want to wait. If the price is overbought, you can wait for it to cross below the 80 mark again into the bullish region in expectation that it will continue to the downside. So let me go to a much more volatile time frame. Here we have like the double top here. We have the double top here. It's a bit above. So that is a divergence. If this is not just a bit above as well, I think it's double top pure, whereas this is just a bit above. So we have the divergence here. Now look at this. If here to this point we have divergence, if you were to be waiting for the break of this divergence low, this is the low of the divergence, right? If we were to be waiting for the break of this low at this point, what do you think will happen? Which happened here? Which is this green candle, right? This particular one. So we used to be shorting after this elongated move. You don't want to do that. You don't want to short the market after you have missed all this. So at times when you wait at the lows, it could be dangerous. But then the moment you spot that there is divergence and then it crosses back inside from the overbought region below the 80 point mark, then you may want to go short. You spot the divergence, you wait for it to come from the overbought region back into the highlighted region, then you go short. And if it's for long, you go long. But if you have to wait for this, you may be losing a lot of money without partaking in it. And when you are ready to partake, the market will just reverse back to the upside. So these indicators are lagging in nature. When these indicators are lagging in nature, why will you still want to use them when you can enter a trade very late? So I'm still looking for some divergence. I want some volatile action. Let me go down to the 15 minutes. Either bearish divergence or bullish divergence. I think we have a bearish divergence here. We have this size to this lows. As you can see, this one didn't quite come into the overbought region. And then we have this size to this point. It is divergence. And because it wasn't at the overbought region, what happened? It came down a little bit, only to continue to the upside. And as it was continuing to the upside of first one making a sideways movement, we saw the money flow reducing. So that is MFI. All this is just for you to locate divergences. All this is for you to locate divergences. So do we have a bullish divergence somewhere around there? Nope, I don't think. Okay, I think, okay, no, we don't. Lot of bearish divergence. Yeah, we have a bearish divergence here. We have this eyes. This quite just made a bit of touch into the overbought region. It was making a lower highs to this, and price was from here moving with an higher highs, right? And then the moment it crossed back from the over, as you can see there, it just crossed above it, right, and closed there. If you can notice, then the moment it crossed back below it is your short signal, which means on this candle here you go short and then the market drops. You have your stop above here, the market dropped all the way to this particular point. So that is one of the ways to use all these indicators. There are many ways you can scalp with it. There are many ways. You can just wait for it to come into the oversold region and then look for buys. You can wait for it to cross above into it and then buy. You can wait for it to get into the overbought region and then closes below it again, then you sell, like we have here. But if you have sold there at this particular point, you wouldn't be in profit, and if you might have even been taken out. So but then it crossed back again below here, which gives you a little profit. Then you have your divergence. So as per this, he wants to play the divergence with the crossing from oversold or overbought back into the highlighted areas. I don't trade with trading indicators. I'm just doing this to give you basic knowledge of how to deploy them and how to, or what to look out for on them. So let's look at the mean reversion indicators. This, I won't go into details on this too as well, just like the volume indicator. So mean reversion indicators are lagging indicators, of course, which measure how far a price swing will stretch before a counter impulse triggers a retracement. These are sort of hidden levels that set retracements into motion, such as resistance points. An example of a mean reversion indicator is the Bollinger Bands. The Bollinger Bands has two outer bands and a median moving average, which denotes support and resistance points as the hidden level where prices are pushed back. Bollinger Bands identifies these turning points by measuring how far price can travel from the median or central moving average before being put back into the median moving average. The outer bands can contract and expand in reaction to volatility, showing traders when this hidden level of support and resistance is no longer an obstacle to rapid price movement. Now, think of the outer bands as a rubber band, which is around a central line, which if the bands move too far away from the central, like when you stretch the rubber from the central point, you stretch it with hand, it will often snap back aggressively we have this weapon we used to play when we were kids back then, like the ones we used to keep bells and lizard and taco. So it's attached to a wooden I don't know what to call it, wooden handle, then with some rubbers on it, which you then put a stone in between the rubber and then you stretch it. The moment you release it, it throws the stone. So think of Bollinger Band as that. The wooden handle is the center point where the bands are aligned with. But the moment it stretches and you releases it, it snaps back aggressively back to that wooden handle. That is how price relates with Bollinger Band. So that is why I asked you to think of it as a rubber band around the central line, in which if the band moves too far away from the central, it will often snap back aggressively, and sometimes it can be overstretched before it snaps back to the central, which gives a sense that the outer bands are not holding as either support or resistance at that particular moment. But be careful, as an overstretched rubber band often retraces very much aggressively. You know, sometimes when you stretch the rubber, it's either it snaps as in cut, or it keeps stretching to the point, whereas you see that this thing is about cutting or breaking. Then you release it, and when you release it, it returns with so much force. So there are many other types of indicators which falls under the categories we have discussed, and most have similar use cases and ways around them, such as the trend Ishimoku clouds, which is seen as an adverse indicator, the parabolic SAR, the rate of change, fractals, pivots, among others. So there are countless of indicators in which we can look at, but the commonly used ones are the ones I have talked about. The parabolic SAR is also a trend indicator similar to the moving average. The parabolic SAR is also a trend indicator similar to the moving averages. Likewise, the Ishimoku clouds. We have the Tenkan and the other bands on it as well. But then let's quickly look at Bollinger Bands and see what we can see about it. So to deploy, you go to your indicators, then you find Bollinger Bands. As you can see, this comprises the price. This is the lower bands and this is the upper bands. So this red line is the moving average, which is the median line. So once the prices are contrasted like this, as you can see, it's contracting as in closing together. It means price is consolidating or in a sideways movement, and soon it will expand. So how do you buy with Bollinger Bands? Bollinger Bands is said to be used when the prices move away. This is a certain line where the prices do pull back to, right? This is the bottom bands which has as support, and this is the upper bands which has as resistance. So you want to buy when the price maybe wicks below the bands and then closes above it. You want to start taking profit from the median line and another take profit at the upper bands. Then you want to sell when it's at the upper bands. As you can see, this candle closes right above it and try to close it back inside of it, then only for it to come to the middle line and then try to come back to the support. And then the moment it came to the support, it touched it here, then it tried moving back up. So you want to use the lower bands as support and the upper bands as resistance. If price is below the median line, then you want to watch that area. Price can break it and go up. Price can also touch it and reverse, like it's happened here, but then it was able to come back above it here. You can also check the settings here and change this length or the standard deviation to whatever you think will work best for you. You just have to look around and play with all this As we see here, price was consolidating and then it expanded there. So these are extended moves, whereas price are overstretched. Price keep rising on the resistance or the outer bands where you could have been placing a sell orders, but then it keep flirting with the outer bands, the upper bounds, and until it then close back well below it, only to then come back to the median line. So here the price or the bands were overstretched and then it came back down here. It found support at the median line only to come back here and find resistance, back to the median line, back to the upper bands, find resistance, and then back to the lower bands. Flirting with it here, send it back, pull back to the median line, and then it met resistance. So that is Bollinger Bands for you. These indicators can be lagging because if you want to use the upper band as resistance, what happens when you start selling here and the price keeps flirting with the upper bands? How can price be flirting with resistance while it is rising? You see, so you want to be wary of all these things. Sometimes it works perfectly well, like here, it came here, found support, went back up, resistance, here support, and then instead of finding resistance here, it started flirting with it. And at this very moment, we have price is facing down, which means it's kind of bearish, right? And like here, it was facing up. The bears were facing up, so it's kind of bullish. So those are the things you want to see about all these trading indicators. It's not rocket science. You can just pick one. Okay, see at this currently price action, it came below it, with below it and close above it, and then it came back into the median line and it's meeting resistance at that particular point now, only to come down. Hopefully it can find support again here, then comes above it here. So that is Bollinger Bands for you. That is Bollinger Bands for you. That is the simple way it's being used. You can find more advanced ways being used. Of course, there are many ways you can play with indicators, but as per the norms of this lesson, it is basic and beginners oriented. So that is the most simplest way you can use Bollinger Bands. Thank you for watching, guys. Now on to our next course, which is levels indicators. You want to stay tuned and watch that. Thank you for being with us.